I want to tell you about two people. The first person is 28 years old. She has been meaning to start investing for 3 years. She has read articles. She has watched videos. She has downloaded 4 different investing apps and deleted 3 of them. She has a list of stocks she has been thinking about buying since 2023, and she has not bought a single one. She tells herself she is waiting until she understands it better, until the market calms down, until she has more money, until the time is right. The second person is also 28 years old. He started investing at 25. He did not wait until he understood everything. He did not wait for the market to calm down. He did not wait for the perfect moment. He simply started with what he knew, put money in consistently, and kept going by the time both of them are 65. The first person will have spent 37 years becoming more comfortable with the idea of investing. The second person will have spent 40 years actually investing, and the difference in wealth between those two people at 65 driven entirely by that 3-year head start and by the compounding that happened inside, it will be extraordinary. It will not be a small difference. It will be the difference between financial freedom and financial anxiety for the rest of their lives. This is the first and most important truth about investing in 2026 and in every year before and after it. The right time to start is always earlier than you think, and the cost of waiting is always higher than you feel today. I am going to give you the complete roadmap for starting to invest intelligently in 2026, not the roadmap that the financial industry wants to give you, because that roadmap is designed to generate their fees, not your wealth. The roadmap that actually works, the one built on principles that have survived every market condition of the last century, and that will survive whatever 2026 and beyond decides to throw at us. The problem with how most people start. Let me describe how most people begin investing in 2026, because if you recognize yourself in this description, I want you to understand that it is not your fault. It is the entirely predictable result of the environment you are being asked to navigate. Most people in 2026 begin investing by opening a social media application. They see someone talking about a stock with enormous enthusiasm. They see the numbers. They see other people in the comments saying they bought it too. They feel the pull of the crowd, and they open a brokerage account and they buy something. They have no framework for what makes a good investment. They have no understanding of what they actually own. They have no plan for what they will do if the price falls, and they have no criteria for when or why they would sell. What they have is a position in a stock that someone on the internet was excited about this week. This is not investing. This is joining a crowd and hoping the crowd continues to move in the direction it was moving. When you joined it, crowds are not reliable. And here is what happens next. About 60 to 70% of the time the price falls. The person who bought it panics, sells at a loss, tells themselves that investing is not for them, and goes back to doing nothing, and the remaining wealth-building years of their life tick quietly past while their money sits earning almost nothing. The tragedy is not that they lost money on that first investment. The tragedy is that one bad experience with the wrong approach permanently closed the door on a habit that would have transformed their financial life. I am going to make sure that does not happen to you before you buy anything. Build the foundation. Here is the single most important thing I want to communicate in this entire video. Before you invest a single dollar in any stock or fund, you must build a foundation, and that foundation has 3 floors, and you cannot skip any of them. The first floor is the emergency fund. I know this is not exciting. I know you came to this video to learn about investing, not to hear about keeping money in a savings account, but hear me out. If you invest money that you might need in the next 12 to 24 months, you are not actually investing. You are gambling with money you cannot afford to lose. Here is why when the market falls, and it will fall sometimes sharply, the only investors who can stay calm, hold their positions, and wait for the recovery are the ones who know that their actual financial life, their rent, their food, their medical expenses, their ability to function does not depend on the value of their portfolio. Today, the investor without an emergency fund is forced to make financial decisions under pressure, and decisions made under pressure are almost always bad ones. They sell at exactly the wrong moment, they crystallize losses that would have recovered, and they exit the market precisely when being in it was most important. Before you invest a single dollar, build 3 to 6 months of living expenses in a separate savings account that you do not touch and that you do not count as part of your investment portfolio. That is the ground floor, and nothing else can be built on top of it safely until it exists. The second floor is the elimination of high-interest debt. If you are carrying credit card debt at 18, 20, or 25% interest and simultaneously putting money into investments that you hope will return 8 or 10% annually, you are losing money in a mathematically certain way. Paying off a credit card, charging 20% interest, is a guaranteed 20% return on every dollar you use to pay it down. There is no investment available to any human being on earth that offers a guaranteed 20% return. Eliminate the high-interest debt first, then invest the money you were paying toward that debt every month. The third floor is the written investment plan. Before you buy anything, you need to write down 3 things: why you are investing, what the money is for, and when you will need it, how much you will invest, and how often, and what will cause you to change that amount. What you will do when the market falls, because it will fall, and the time to decide your response is before the fall happens, not during it when your emotions are involved and your judgment is compromised. These 3 floors are not optional preparation. They are the investment itself. They determine whether everything that comes after them works or fails. Understanding what you are actually doing when you invest. Now let me make sure you understand at a foundational level what investing actually is, because most people who begin in 2026 have a fundamentally incorrect mental model of it. When you buy a share of stock, you are not buying a number on a screen. You are buying a small fractional ownership stake in a real business. That business has real employees and real products and real customers, and it either produces genuine profits for its owners or it does not. The value of your ownership stake is determined by what that business produces for its owners over time. The price of the stock in the short term is determined by what other people feel like paying for it. Today, these 2 things are related in the long run, but they can diverge dramatically in the short run, and that divergence, the gap between price and underlying value, is the central fact that every intelligent investor must understand and must never forget when the market falls and people sell their stocks in panic. They are not responding to a change in the underlying businesses. The coffee shops are still making coffee, the pharmaceutical companies are still selling medicine, the technology businesses are still processing transactions. What changed is how much the crowd feels like paying for those businesses today, and the crowd's feelings about price in the short term are almost completely irrelevant to the long-term value the business creates for its owners. When you understand this, you stop seeing a falling market as a loss and start seeing it as what it actually is, a sale. The same business at a lower price is simply a better deal for the buyer and a worse deal for the seller. The intelligent investor is always trying to be the buyer when prices are low, not the seller. The 2 starting strategies and how to choose between them. Now that you understand what you are doing, you need to choose how to start. And I want to be direct with you. There are 2 approaches that make sense for a beginner investor in 2026, and only 2. Everything else is either speculation dressed as investing or complexity that adds cost without adding return. The first approach is what I would recommend for the vast majority of people beginning today. It is simple, systematic, and has an extraordinary track record over every long period of market history. Buy a low-cost, broadly diversified index fund at regular intervals, regardless of what the market is doing. That is the complete strategy. A low-cost index fund simply buys a small piece of every significant business in the market. It spreads your investment across hundreds or thousands of companies, so that the failure of any single company cannot significantly damage you. It charges you almost nothing in fees compared to actively managed funds, and it captures the overall return of the market, which over long periods of time is genuinely excellent. The regular interval part is equally important. This approach, called dollar cost averaging, means you buy a fixed dollar amount at regular intervals monthly or with every paycheck, regardless of whether the market is up or down when the market is high. You buy fewer units when the market is low. You buy more units automatically without having to make any decisions about timing over long periods. Dollar cost averaging into a low-cost index fund has beaten the vast majority of professional active investors who were paid handsomely to do better. It is boring. It requires almost no skill once it is set up, and it works better than almost everything else. If you are starting today with no framework, no financial statement, reading ability, and no circle of professional expertise to draw on, this is your strategy. Execute it completely and do not let anyone talk you out of it. The second approach is for the person who has taken the time to genuinely learn how to read and interpret financial statements, who has identified a specific industry or category of business they understand better than most people, and who is prepared to do the work of researching individual companies carefully. This person can complement their index fund core with a small allocation to individual companies that they have genuinely analyzed and that they believe are selling for less than they are worth. The critical word is genuinely. Not companies they read about on the internet, not companies someone in their life recommended, not companies making products they personally love, companies they have read the financial statements of, companies whose competitive advantages they can articulate clearly, companies whose risks they have honestly assessed, and companies they would be comfortable owning at the current price if the stock market closed for the next 5 years and they received no price quotations at all. That last test is mine, and I stand by it completely. If you would not be comfortable owning the business for 5 years without a daily price quotation, you do not own it with genuine conviction, and without genuine conviction, you will sell at exactly the wrong moment. The enemies of the beginning investor in 2026. I want to spend time on something that did not exist when I was teaching at Columbia, but that is now the single greatest threat to the beginning investor, the financial internet. Not the information on it, which can be genuinely useful, but the incentive structure behind it. Every person creating content about investing in 2026 is incentivized in some way by your attention and your activity. The financial media is incentivized by clicks, and clicks come from excitement, not from patience. The financial influencer is incentivized by followers, and followers come from entertaining content, not from boring correct advice. The brokerage platform is incentivized by trading activity, and trading activity comes from anxiety and excitement, not from the calm long-term holding that actually builds wealth. None of these incentives are aligned with yours. Yours is to buy good assets at reasonable prices, hold them for long periods of time, and avoid the transaction costs, taxes, and emotional mistakes that come from excessive activity. Theirs is to keep you watching, keep you trading, and keep you coming back for the next exciting thing. I am not telling you to avoid financial content entirely. There is genuine value in understanding the principles behind investing. I am telling you to build your investment process on those principles, and then to stop looking for new information that might lead you to change course. The investor who checks their portfolio every day and reads every piece of financial news is not better informed. They are more anxious and more likely to make a decision driven by the emotion of the moment rather than the logic of the long term. Build the plan, follow the plan, and then leave it alone. The compounding will happen whether you watch it or not, and it happens faster when you stop interrupting it. The most common mistakes beginners make and how to avoid every one of them. Let me name the specific mistakes I have watched investors make at the beginning of their investing lives and tell you exactly how to avoid each of them. The first mistake is waiting for the right moment to start. There is no right moment. The market is always either higher than it was or lower than it was, and neither fact tells you anything reliable about what it will do next. The best time to start is when you have the foundation in place and the money available. The second best time is tomorrow, but not next year. The second mistake is investing money. They cannot afford to lose. I have described this above, but I want to emphasize it again with force. The emotional damage of losing money you needed creates an aversion to investing that can last decades. Invest only money whose temporary disappearance you could survive without changing your actual life. The third mistake is diversifying too little. Putting all of your early investment money into one or two stocks is not bold, it is reckless. No matter how confident you feel about the businesses, concentration of this magnitude requires a depth of research and conviction that very few beginning investors actually have. Start broadly and narrow your focus only as your knowledge and your track record justify it. The fourth mistake is checking the portfolio too often. I recommend looking at your portfolio once per quarter at most, and only to rebalance if something has drifted significantly from your intended allocation. Daily checking does not improve returns. It increases anxiety, and anxiety produces decisions that damage returns. The fifth mistake is reacting to market drops by selling. This is the most expensive mistake in investing, and it is almost universal among beginning investors. A market drop is not a signal to sell. It is a signal to ask whether the underlying businesses you own are still fundamentally sound. If they are, the lower price is simply the same asset at a discount, and selling it is giving that discount to someone else who will benefit from the eventual recovery. Write this down before the next market drop occurs, so that when it does, you have already decided what you are going to do. Your assignment here is your complete starting framework, and I want you to treat this not as suggestions, but as a sequence that you follow in order. Step 1. Calculate your emergency fund target, 3 to 6 months of your actual monthly expenses. Write the number down and open a separate savings account today with the specific purpose of reaching that target before you invest a single dollar in anything else. Step 2. List all debts with interest rates above 10% and calculate the monthly amount you are currently paying toward them. These get eliminated before serious investing begins. Step 3. Write your 3 investment decisions, the purpose and timeline of the money, the fixed amount and frequency of your contributions, and your written response plan for a market drop of 20% or more. Step 4. Open a brokerage account at a reputable low-cost provider and set up an automatic monthly investment into a broadly diversified low-cost index fund. Treat this contribution exactly like a bill that gets paid every month without a decision being required. Step 5. If and only if you have completed all of the above and you have spent real time learning to read financial statements, and you have identified a specific area of business, you understand better than most people, allocate a small portion, no more than 10 to 15% of your investable assets to individual companies you have genuinely researched. Then stop adding complexity. Let the compounding work. Let the contributions accumulate. Let the years pass. Wealth is not built by finding the perfect investment. It is built by starting correctly, staying the course, and giving time the room to do what time does better than any investment strategy ever invented. The bottom line, the smart way to start investing in 2026 is not different from the smart way to start in any other year. Build the foundation before you build anything on top of it. Understand what you are actually buying when you buy a share of a company. Choose the strategy that matches your genuine temperament and your genuine commitment of time, not the strategy that sounds most impressive at a dinner party. Protect yourself from the financial internet's incentive to keep you active, anxious, and trading. And above all else, start now, not when the market calms down. The market never stays calm for long. Not when you have more money. You will always have slightly more money later. Not when you understand it better. The understanding comes from doing, not from waiting to do. The first dollar invested with a sound plan is worth more than $10,000 planned but never committed. Start today. Build the habit. Let the compounding begin. That is the smart way to start investing in 2026. That is how the intelligent investor thinks. Thank you.